Wow, this is just literally crazy. Welcome back to another explainer, everyone. Today we are diving into what has to be one of the most explosive head-spinning market events in recent tech history. I'm talking about the Cerebras Systems IPO. Now, for months, this was hyped up as the definitive alternative to NVIDIA, the absolute next huge wave in AI hardware. So the stock opens to this massive fanfare, everyone is cheering. But then almost immediately, the bottom completely falls out, it just plummets. Joining me today to cut through all this noise and tell us what is actually happening behind the scenes is our chief investment analyst.
Thanks for having me. You're right, the headlines right now are completely chaotic. There is a lot of panic and a lot of hype. But underneath all of that noise, the S1 filings actually tell a very clear, highly objective story. Today we are going strictly by the numbers. We are going to break down exactly what drove this extreme volatility, completely removing the narrative and focusing entirely on verifiable market data. If you look at the financials, the reasons for this crash are hiding right there in plain sight.
We're going to conduct this fundamental deep dive in 4 strict stages. First, we will examine the wild Cerebras IPO itself. Second, we are unpacking the actual S1 financials. Third, we'll analyze their wafer-scale moat and what makes their technology different. And finally, I will lay out 3 data-backed survival scenarios for the company moving forward.
All right, let's jump right in. Stage 1, the wild Cerebras IPO, and this massive market momentum trap we are seeing.
Okay, so just look at these numbers. Cerebras originally priced its initial public offering at $185 per share. But when it actually opened to the public on May 14th, the demand was so insane that it debuted at $350. That is nearly double its IPO price right out of the gate. And then, literally just days later on June 5th, it closed at $201. That is a massive 42% loss from the open. I mean, my portfolio would be crying. Are retail investors just getting played here by the big guys, or is there a fundamental, logical reason for this massive whiplash?
If you look at the historical data regarding highly anticipated semiconductor IPOs, this specific pattern is a textbook momentum trap. The stock market right now is essentially repricing the entire company from a narrative-driven valuation to a fundamental-driven valuation. When a hyped tech company IPOs, there's very often a massive disconnect between the story being sold to the public and the actual verifiable numbers sitting on the balance sheet. That initial surge up to $350, that was entirely driven by retail enthusiasm over finding a potential NVIDIA killer. The narrative was very simple for the average trader. AI is booming, NVIDIA stock is getting too expensive, so let's blindly buy the next big thing.
Right, the classic FOMO trade, fear of missing out on the next big tech giant.
Exactly. However, the subsequent drop down to $201 reflects the institutional players stepping in. I'm talking about the hedge funds, the mutual funds, the large asset managers. They are evaluating the actual operational data within the S1 filing. And institutional investors, they don't buy stories. They buy cash flows, and they buy sustainable growth. As they heavily scrutinized the S1 document, they saw severe structural risks that the retail investors completely ignored during the opening day hype.
The extreme volatility we are witnessing comes down to 3 operational realities documented in their filings. First, there is extreme customer concentration, which represents a highly significant structural risk to their revenue floor. Second, they have a massive cash burn rate that is directly tied to building out their own proprietary cloud infrastructure. And third, they represent a complete departure from the NVIDIA ecosystem. Cerebras is attempting to create an entirely separate technological paradigm, rather than simply plugging into the existing NVIDIA-centric software stacks that everyone already uses. You see, NVIDIA's real economic moat isn't just their physical hardware, it's their CUDA software platform. Millions of AI developers have been locked into CUDA for over a decade. Cerebras is asking the entire tech industry to learn a completely new way of compiling and running AI models, which creates immense friction for any sort of rapid enterprise adoption. Okay, hold on. Let me summarize that to make sure we're all on the same page. Basically, what you just said means they crashed because they are burning a mountain of cash, relying on a tiny handful of customers to pay the bills, and trying to fight NVIDIA entirely alone by building a competing software ecosystem from scratch. Wow. That is a ridiculously heavy lift. It's like a startup trying to launch a brand new smartphone operating system against Apple and Android today and expecting everyone to just switch over. But that brings up a really huge question about how they actually plan to compete on the physical hardware front. What on earth are they building that gives them the confidence to take on a multi-trillion-dollar giant like NVIDIA? To understand their core business structure, we really must look at their hardware approach, because it is radically different. Traditional architecture, like what NVIDIA produces, relies on clusters of thousands of relatively small GPUs that are all linked together across incredibly complex networking layers. The Cerebras architecture, specifically what they call the Wafer Scale Engine 3, or WSC3, flips this completely upside down. They manufacture one massive 8.5-inch squared chip on a single silicon wafer. Instead of taking that wafer and cutting it into hundreds of small individual chips, they keep the entire wafer completely intact, packing 4 trillion transistors onto one continuous giant piece of silicon. Wait a minute, doctor. Before we get completely lost in the engineering jargon here, what does wafer-scale integration actually mean in the real world? That sounds too complicated. Could you give us a simple analogy, something an elementary schooler could picture? Absolutely. Consider a traditional GPU cluster as a fleet of thousands of small delivery vans trying to coordinate moving a massive mountain of packages, which represents the AI data, across a very bustling, crowded city. Those vans inevitably get stuck in traffic. Figuring out the routing takes intense management, and the communication between the different vans takes a whole lot of time and energy. The network switches and the fiber optic cables in a data center are essentially those city streets, and they easily get congested. Now, Cerebras' architecture is fundamentally different. It is like building one gigantic, immovable freight train where all of the packages are already loaded inside, the exact same vehicle. There is absolutely no traffic jam. The data never has to leave the chip to travel across the network cable. This entirely eliminates the interconnect bottlenecks and the networking delays found in traditional GPU clusters. It means the processing cores can talk to each other almost instantly. Oh, okay. I see it now. By keeping all the computing power on one giant dinner plate-sized chip, they literally just skip the data traffic jams completely. It's a localized supercomputer on one single slice of silicon. No cables, no traffic. That is a brilliant way to understand it. But let's look at the actual business side of this. What does building this massive freight train actually cost them? If the hardware is this unique, the economics must be drastically different from standard chips.
Which brings us perfectly to stage 2, unpacking the financials. Let's look at the cash flow and the revenue. Reviewing the raw S1 financials, the revenue growth trajectory is structurally exponential. The data here is very clear. In 2022, they generated just $24 million. By 2024, total revenue had reached roughly $290 million. And for the year ended December 31st, 2025, revenue skyrocketed to $510 million. If we break that specific figure down, hardware sales accounted for $358.4 million, while cloud and other services brought in $151.5 million. This effectively proves that they are successfully monetizing their systems in the real world. They aren't just an experimental research lab. However, to evaluate the company accurately, you must also look at the profitability metrics to see the complete picture. And the data shows that this growth is absolutely not free. In 2024, they posted a net loss of $481.6 million. And in 2025, while their top-line revenue grew beautifully, their net cash used in investing activities expanded massively to $667.6 million. They are bringing in more money than ever before, but the capital outflow is accelerating at an even faster rate. To put that into perspective, for every single dollar of revenue they brought in during 2025, they were bringing significantly more than $1 just to scale their operations.
Wait a minute. Let me play devil's advocate here. If they are bringing in $500 million in revenue, which, let's be honest, is a serious, massive milestone for a young hardware company, why are they bleeding so much cash? And more importantly, what does that have to do with our stock accounts? Why is the market punishing them so brutally when they're growing their top-line revenue this fast? Isn't hypergrowth exactly what tech investors are desperately looking for?
That is the pivotal question. The negative market reaction is driven entirely by the severe capital intensity of the recent business model pivot. It is true that hypergrowth is generally rewarded by Wall Street, but only when it scales efficiently. However, the cash flow statement reveals a major strategic shift. They are no longer simply a fabless chip designer selling hardware to existing data centers. They are actively transitioning into a full-fledged cloud service provider themselves. They're actually building the physical data centers from the ground up. This specific strategy requires staggering upfront capital expenditure. You have to buy land, secure massive power contracts, build cooling systems, and install the servers long before a single dollar of recurring cloud revenue can ever be recognized. The market is aggressively discounting the stock right now because the pathway to achieving free cash flow is suddenly much longer and astronomically more expensive than investors initially thought.
Let me break this down even further with the exact figures from the filing. The S1 explicitly states that the $667.6 million in net cash used for investing activities in 2025 was primarily driven by $382.7 million in purchases of property and equipment. Specifically, these are the massive systems deployed to actually deliver Cerebras cloud services. The company is currently building enormous, high-speed inference data centers in locations like Dallas, Minneapolis, Oklahoma City, and Montreal.
Furthermore, to financially sustain this extreme level of cash burn, they were forced to secure an $850 million revolving credit facility in early 2026. Keep in mind, this debt was taken on top of raising a $1 billion Series G and a $1 billion Series H equity round just prior to the IPO. When institutional investors look at this, they see a company that must continually raise billions of dollars just to keep the lights on for its cloud built out. Every single time they issue new debt or issue new equity to fund these massive data centers, it either directly dilutes existing shareholders or adds incredibly heavy interest burdens to the balance sheet. That constant threat of dilution is exactly what institutional asset managers are pricing into the current depressed stock valuation. Wow, okay, so in simple terms, they aren't just selling the hardware to other people, they're trying to become their own mini Amazon Web Services. And building those massive data centers from scratch is literally eating their cash faster than they can earn it. It changes them from a high-margin, lean chip company into a super capital-heavy infrastructure play. That definitely explains the extreme financial pressure we saw in the stock price. The market doesn't like unexpected massive expenses.
All right, let's move on to stage 3, the wafer scale mode. We need to look at this irreplaceable weapon they have and see if it's actually worth all this cash burn. Despite the financial risks, they do possess a highly distinct technological moat. If you look at the data here regarding the WSE3 chip, it is 57 times physically larger than a leading GPU. It features 880 times more on-chip memory and 7,000 times more memory bandwidth. What this translates to operationally in the data center is absolutely blistering speed for very specific AI tasks. The S1 documentation, which was benchmarked independently by artificial analysis, proves that for certain workloads, particularly large language model inference, Cerebras is up to 15 times faster than leading GPU-based solutions. This architectural advantage physically allows them to process entire massive AI models directly on the chip's internal memory. They completely avoid having to constantly fetch data from external storage or having to partition a single model across hundreds of separate GPUs, which is precisely what slows traditional computing clusters down. And this right here illustrates exactly why people are still so excited, despite the drop. Speed is literally everything in the AI arms race right now.
Precisely. Let's examine the comparative throughput data directly. This chart clearly details the output speed measured in tokens per second from Meta's Llama 3's 37B model. Databricks achieves 62 tokens per second. Azure achieves 111, Google Vertex hits 143, Amazon reaches 164. Cerebras completely obliterates these figures, outputting an unprecedented 2,457 tokens per second. In the business of generative AI, where things like interactive voice avatars, digital twins, and real-time autonomous coding agents require near-zero latency, this level of throughput is a highly differentiated, irreplaceable weapon. For enterprise applications where waiting even 1 single second for an AI to respond completely breaks the user experience, Cerebras is offering an order-of-magnitude leap in performance. Traditional distributed GPU clusters simply cannot physically match this right now due to the fundamental laws of networking physics. Oh my God, really? Over 2,400 tokens a second compared to Amazon's 164? That is insane. To put that in perspective, that's like generating an entire multi-page essay in a single second. But I have to interrupt you again. If this is legitimately 15 times faster than NVIDIA hardware running on Amazon, what is the catch? Why isn't every single Fortune 500 company completely dumping their GPU clusters and switching to Cerebras right this second?
The data indicates severe operational and structural constraints that actively prevent mass immediate market adoption. The core technology is undeniably phenomenal, but deploying it at an enterprise scale introduces major physical and economic hurdles. To understand why companies aren't switching overnight, we must objectively look at the fatal weaknesses documented in their own risk factors.
While exact profit margin figures are tightly guarded in the S1, qualitative analysis of their business structure reveals 3 severe operational risks. First is the extreme power draw. Each individual system draws 25 kilowatts of power. This severely limits where these supercomputers can be physically deployed. Most legacy enterprise data centers simply do not have the power density or the advanced cooling infrastructure to support them. Second is the sheer upfront hardware cost. Industry estimates place the cost at up to $3 million per node. That makes it a massive capital commitment for any enterprise looking to buy the hardware outright instead of renting it via the cloud. Third, and arguably the most critical, is the supply chain risk. Taiwan's Semiconductor Manufacturing Company, or TSMC, is currently the only company on Earth capable of manufacturing these 8.5-inch wafer-scale chips with an acceptable, profitable defect rate. Etching a silicon chip this incredibly large without introducing fatal microflaws is a masterclass in precision engineering that took years to perfect.
If TSMC experiences any sort of geopolitical disruption in the region, a natural disaster, or an operational halt, Cerebras's entire hardware production stops instantly. They cannot simply move their production over to Intel Foundries or Samsung. The manufacturing process is far too bespoke and deeply integrated with TSMC's proprietary packaging technologies.
So basically, the chip is an absolute Ferrari, but it costs a fortune. It needs a highly specialized gas station that barely exists anywhere, and it relies entirely on one single factory in Taiwan to actually be built. That is a lot of single points of failure for a public company trying to disrupt an entire global industry.
That is a highly accurate summary of the hardware risks. However, furthermore, there is one specific financial risk factor detailed in the S1 that completely dwarfs all the others: extreme revenue concentration. If you look at the data, a staggering 86% of their 2025 revenue came from just two closely linked customers. The Mohammed bin Zayed University of Artificial Intelligence accounted for 62% of total revenues, and G42 accounted for 24%. Both of these entities are deeply tied to sovereign AI initiatives located in Abu Dhabi. This essentially means Cerebras is currently reliant on the strategic AI spending of one specific national government. Relying on a single geographic and institutional entity for nearly 90% of your total income is a massive corporate vulnerability. If those specific contracts are altered in the future, if sovereign priorities suddenly shift, or if U.S. export controls restrict advanced AI hardware sales to the Middle East, the company's entire revenue floor completely collapses.
Wow. No way. 86% of your total revenue tied up in basically one single region's AI initiative. If that contract goes south for any reason, the stock basically goes to zero. That is utterly terrifying for a retail investor, and it perfectly explains the massive institutional sell-off we saw. The big money saw that concentration and got out.
All right, stage 4, 3 survival scenarios. Analyst, bring it all home for us. Give us the data-backed forecast for where this stock actually goes from here. Based strictly on the current verifiable data, we can forecast 3 strict survival scenarios. Scenario 1 is the bull case, which is the highly optimistic outcome. The fundamental precondition or trigger for this scenario is the successful execution of their recent mega deals. In January 2026, they signed a massive $20 billion deal to deploy 750 megawatts of compute specifically for OpenAI. This is a monumental validation of their underlying technology by the absolute industry leader in AI. They also signed a major agreement with Amazon Web Services to deploy systems for AWS Trainium. If these massive partnerships successfully trigger mass enterprise adoption, it will effectively diversify their revenue away from G42 and definitively prove that their heavy capital cloud model works at a global scale. If this happens, the stock will aggressively re-rate upwards. The market will heavily reward them for successfully becoming the back-end infrastructure for the world's most demanding AI applications. Scenario 2 is the base case, the neutral and statistically most likely future, based on the current trajectory. Here, Cerebras maintains steady, solid revenue growth by fulfilling the OpenAI and AWS contracts. However, the persistent, heavy cash burn required to build those data centers remains a significant drag on the stock price as they slowly chip away at NVIDIA's total dominance. In this scenario, they survive, and they successfully scale, but true GAAP profitability remains many years away. They become a highly vital secondary player in the broader market, but the immense ongoing capital expenditure keeps the stock valuation relatively grounded. Scenario 3 is the bear case, the pessimistic outcome. In this situation, the extreme $3 million node costs aggressively deter broader enterprise adoption. Additionally, the heavy customer concentration in the Middle East fractures, perhaps due to rising geopolitical tensions or regulatory export bans, or a severe TSMC supply chain shock occurs. If any of these risks materialize, it would cause an immediate catastrophic liquidity squeeze. Without incoming reliable revenue to fund the massive data center buildouts, they would be forced into highly dilutive capital raises, which would crush the stock price even further and potentially lead to a distressed sale or bankruptcy of the company.
Okay, so to put this all together for everyone watching, Cerebras is essentially walking a massive financial tightrope right now. They either leverage these huge OpenAI and Amazon deals to become a global standard and achieve the economies of scale they desperately need, or they simply run out of cash trying to build the immense physical infrastructure required to get there. It is literally a high-stakes race against their own balance sheet. So, to summarize this entire IPO momentum trap, we have to look to a legendary quote by Warren Buffett. He said, "The stock market is a device for transferring money from the impatient to the patient."
The retail investors who completely chased that $350 high on opening day, blindly buying into the hype without actually reading the S1 cash burn data, they were the impatient ones. But the ones waiting on the sidelines right now, watching the numbers, waiting to see if this massive OpenAI deal actually fixes their cash burn before allocating their capital, they are the patient ones. Thank you so much for watching today's Explainer. Your subscriptions, your likes, and your supportive comments are a huge encouragement for our production. So, what do you think? Will Cerebras' wafer-scale technology successfully crush NVIDIA's dominance? Or is this massive cloud infrastructure cash burn a fatal flaw that they just won't ever recover from? Let us know your thoughts in the comments down below, and we will absolutely see you in the next one.